Technical analysis. Here are the items that we will cover. Technical analysis has historically been used by analysts and traders. Now it has also gained acceptance among regulators and the academic community. Essentially, what we will study in this reading are the various tools that are used in technical analysis. First, let's go over a basic definition and the scope of technical analysis. Technical analysis is a form of security analysis. Technical analysis uses price and volume data, which is often graphically displayed. The most basic form of technical analysis would involve looking at a line chart of a given stock or some other security, where we look at the prices over time, and then we use this data about the stock price and potentially volume, which is depicted at the bottom of the chart, to determine what the trend is and whether or not to purchase this stock. One of the advantages of technical analysis is that it does not require a detailed knowledge of the underlying instrument. So if you are evaluating the General Electric stock, for example, with technical analysis, you would be focused on the market data related to General Electric, the stock price currently, the stock price in the past, the volume data, and so on. You really do not need to know too much about the business or the various businesses of General Electric, the industries that it operates in, the economy, and so on. The objective of technical analysis is to make a buy, sell, or hold decision. You will often hear the term technical data, and just to clarify, technical data simply means price data, volume data, and the trends associated with price and volume. The underlying logic behind technical analysis is as follows. Number one, that it is supply and demand which determine prices, and therefore changes in supply and demand cause changes in prices. If you take a given stock, let's say that it has a supply at a given point in time, and there is also a demand for that stock. The price at a given point in time is determined by the intersection of the supply and demand. This is basic economics. If there is an increase in demand, the demand curve will shift to the right and the price will go up. Another example is that you have a given supply and a given demand curve. Let's say that there is a secondary offering of this security, which will cause the supply to increase. Assuming the demand is the same, according to this supply and demand model, the price is likely to come down. Prices can be projected with charts and other technical tools. So as shown over here, we try to project the future price using charts and graphs, which we will be studying in a lot more detail. Moving now to the principles and assumptions. Technical analysis can be thought of as the study of collective investor psychology or sentiment. You need to recognize that human behavior is driven by emotion. Therefore, human behavior is not always rational. Market participants are human, and since it is human beings who are buying and selling stocks, then irrational human behavior means that the markets will also tend to reflect that irrational behavior. And hence, the markets are not necessarily rational or efficient. Technical analysts, or technicians as they are often referred to, rely on the patterns and trends of a given security to predict future security prices. Here is a graphical depiction of how technical analysis works. At any given point in time, there is a certain knowledge and sentiment that investors have and other market players such as hedgers, insiders, other stakeholders. So there is this collective knowledge and sentiment which impacts the trades which take place related to a given security. It is the trades that impact the price and volume data of a security. In order to understand the sentiment of the various market participants, a technical analyst carefully studies the price and volume data. When he studies this data, he is essentially trying to gauge the sentiment of the market participants. Based on his understanding of the sentiment, he will try to predict a trend or pattern in the security price and then make a decision as to whether he should buy or sell the security. It is important to understand the distinction between technical and fundamental analysis. Both methods are useful, but they approach markets in different ways. With technical analysis, we analyze markets and the trading of financial instruments, and we focus on well-defined price and volume data. So in a sense, this is a limited but practical approach. On the other hand, with fundamental analysis, we have a much broader field which covers all factors which might impact security prices. So if you are evaluating the Microsoft stock, with technical analysis, you would be focused on the volume data, price data, and so on. But with fundamental analysis, you need to look at a lot more. You need to properly understand the business that Microsoft is in, what Microsoft competitors are doing, how the overall industry is performing, how the economy is performing, and so on. So you need to deal with large amounts of both objective and subjective information. So in a sense, this is a lot more theoretical. Coming back to technical analysis, you need to also understand a few limitations. Technical analysis is limited to studying market trends and ignores other predictive analytical methods. So as mentioned before, all you are focused on is market data. So any other information that will allow you to gauge the direction of the stock movement is ignored. And hence, with technical analysis, you identify market moves only after they are underway. So if a stock is in a downtrend, only once the uptrend starts do you recognize that there is a uptrend. There are several tools which are used in technical analysis, and those tools include charts, trend analysis, chart patterns, technical indicators, and cycles. Over the next few minutes, we will be looking at how to use these tools. Let us start with charts. There are different types of charts which are used by technical analysts. The charts include line charts, bar charts, candlestick, point and figure, and then there is the concept of a relative strength analysis, which we will talk about after covering the various sorts of charts. Let us look at the most basic chart, which is a line chart. This is a simple graphical display of price trends over time. We essentially have one data point per time interval. So your time interval might be a day. At the end of every day, you essentially plot the closing price for a given stock. And you notice here that for 2006, we have the closing price of a given stock. Here we are simply looking at price data. So we have price on the y-axis, time on the x-axis. Very often with a line chart, you will also see volume data. So on every day where you have the stock price, you will also have a bar which indicates the level of trading. So on this day, there might be a certain amount of trading. On the next day, you might have a higher volume of trades, which will be depicted by a higher line. So overall, you will have the skyscraper sort of depiction at the bottom, which tells you the trading volume. A bar chart is a slightly more sophisticated chart. which has 4 data points in each entry. So for every day or every period. Now, a period could be a day, as I just mentioned, or a period could also be a week. So let's say that this represents a given week. Again, the x-axis is time, the y-axis is price. So for every period, we have a bar chart that looks something like this, where if we take each bar and expand it, here is what we are looking at. The bar tells us the opening price, so that is this indicator to the left of that straight line. This tells us the opening price. The opening price might be 30. The closing price, which in this case is shown over here, that might be 28. You might have a high for the day, which is 31, that's depicted by the top of the line, and a low for the day, which might be 26. So notice we have 4 pieces of information in each bar. And again, very often with a bar chart at the bottom, you will also be given the trading volume for that period. A candlestick chart is very similar to a bar chart, but is easier to read. Each candle has 2 elements, a body, which is this main part, and a wick or shadow. A white body means that the market closed up. So the open is at the bottom, the close at the top. Close is greater than open. So if the stock opens at 28, closes at 30, you will have a white or clear body. A dark body means that the market closed down. So if on the next day the market opened at 30 and closed at 27, then you will have a dark body, and here the close is lower than the open price. For every period you have a particular candlestick. Notice that if you have alternating white, black, this shows high volatility in the stock price. The stock is going up and down. If you see periods of clear, this indicates a uptrend. Dark periods, this clearly shows a downtrend. As with the earlier 2 pictures or charts, you have price on the y-axis and time on the x-axis. Price moves are more visible compared to the bar chart, which is why the analysis of a candlestick chart is faster and somewhat easier. Point and figure chart. In all the earlier charts, we focus on time on the x-axis, and we also often see volume data at the bottom. With point and figure chart, the time and volume data are not presented. The focus is on price changes, and let's understand how. Say you are evaluating a given stock and the initial price is 20. You are concerned with changes in price. So what we do is use 2 symbols here, the O and the X. The O indicates a decrease in price, the X indicates an increase in price. We need to specify what we mean by a increase or decrease. Or more specifically, we need to specify what is a meaningful increase and what is a meaningful decrease. That is done using a box size. Let's say that in our example, the box size is $1. This means that if our stock starts at 20 and the price then changes to 19.90, there will be no new entry made in our point and figure chart. Only if the stock price goes down to 19 do we make this new entry, which tells us that the price went down. The next day the price goes down to 18, and notice that these are the close of day prices that we are concerned with. So if the price goes down, then we are putting the next circle. As long as we stay within something called a reversal size, in other words, as long as no major reversal is happening. So if you have a stock movement like this, we keep on the same column. Only when there is a somewhat substantial reversal, do we move to the next column? So clearly we need to define what that substantial reversal might be. In this case, we have defined the reversal size as 3, which means that if at some point in time there is a reversal of 3, so on a given day the stock price might go up by 3, then we open up a new column. So if the price changes by 3 or more in the opposite direction, then we start this new column, and as long as the stock price keeps going up, or even if it goes down but by less than the reversal amount, then we stay in this column. The prices that we ultimately show over here are based on end of day prices. Some people might wonder why the difference between these two is not 3, and the answer is that what we are looking at here is closing day prices. During a given day, if there is a reversal of more than 3, that's where we open up the new column. It is possible though that the close price on one day is 15, and even though the next day the reversal happens of 3, but the closing price might be 16, which is less than the reversal size. So there are two main points related to this figure that you might be tested on. One is recognizing that with the point and figure chart, the x-axis represents the number of changes in direction. So if you look at a point and figure chart for a given month, say May 2013, then the number of columns that you see gives you an indication for how many reversals they have been, or in other words, how volatile this particular security is. Moving now to relative strength analysis. Relative strength analysis is used to compare the performance of a particular asset with that of a benchmark. The black line over here does a relative strength analysis for stock A relative to the S&P 500. We come up with this line by simply taking the price of stock A and dividing by the price of the S&P 500. You can see that during this region, stock A is going up more than the S&P 500. Or if we have the stocks going down, it is possible that stock A is going down less than the S&P 500. So the relative strength of stock A compared to the S&P 500 is strong or positive. On the other hand, in the same time period, stock B is weak relative to the S&P 500 because the graph is going down. So this means that if stock B is going up but not as much as the S&P 500, then clearly stock B is weak relative to the S&P 500. Next we move to trend analysis. Market participants often display a herd mentality. So if they see a few powerful investors acting in a certain way, then the rest of the market often tends to follow suit. And because of this herd mentality, trends in the market tend to stay in place for some time. We need to understand some basic terminology. When stocks are going up, we say we have a uptrend. An uptrend is where we have a situation like this, where the highs are reaching new highs and the lows are also ending up higher. If we are to draw a trend line for a uptrend, we need to touch all the lows. So remember this point, with a uptrend, the trend line connects the lows. With a downtrend, you have a situation like this. Stock is going down. The lows are lower and the highs are also lower. The trend line for a downtrend touches the highs. You also need to understand the concept of support, resistance, and polarity. With support, we are talking about a low price range in which buying activity is sufficient to stop the decline in price. If you take a given stock where the support level is 80, What we are saying is that when the stock price comes down to 80, market participants believe that this is a low price for the stock and people start to buy, which means that the price again starts going up. The resistance level is the high range. So this is the price range in which investors start to sell, believing that this stock has now reached its high level point. Because of this selling, the price starts going down. It isn't necessary that the stock will remain in this range forever. If we have a situation where the old resistance now becomes the new support level, in other words, the stock has broken out of this particular pattern, then we say we have a change in polarity. So just to read this out, once the support level is breached, that's happening over here, it becomes a resistance level. And once a resistance level is breached, it becomes a support level. Now actually what is happening over here is the resistance level has been breached and it is becoming a new support level, where we have the opposite situation where you have a stock that goes down in value. Here the support level is being breached and this might become the new resistance level. So both of these are examples of changes in polarity. Moving now to chart patterns. Chart patterns are formations that create a recognizable shape. Common patterns appear repeatedly and lead to similar subsequent price movements. We can have reversal patterns which tell us that an uptrend is going to end and we'll now have a downtrend, or a downtrend is going to end and we are going to have a uptrend. We need to recognize these patterns which tell us that there is going to be a reversal. Continuation pattern means that a given trend will continue. So we have this trend, then there'll be a certain pattern. We need to recognize the continuation pattern because this will tell us that the trend will continue. The purpose of this slide is that you simply memorize the various reversal and continuation patterns. What we will now do is cover those patterns in a little bit of detail. The most important reversal pattern is the head and shoulders pattern, which looks like this. We have a uptrend. There is this concept of a neckline, where after the neckline the stock goes up a little and down. So this is the shoulder. Then it goes up a little more to a level called the head, and then down again to the neck, up to the shoulder and back down. Let's say we have a situation where the neckline is 70, the shoulder is 75, and let's say that the head is at 80. According to the head and shoulder pattern, which is a reversal pattern, after this pattern there is going to be a move down. So we can actually predict the target price using this formula. The price target is the neckline, which is 70, minus the difference between the head and the neckline. The difference between the head and the neckline is equal to 10. That's 80 minus 70. So the target price here will be 60. The inverse head and shoulders pattern is essentially a mirror image of what you saw, and here the target price is simply the neckline plus the neck minus head. In this particular case you have a downtrend, the pattern, and then there is a reversal, so the stock price starts going up. We can also have double tops and bottoms, triple tops and bottoms, and they are fairly self-evident here. Notice these are reversal patterns. This is a double bottom. This is a triple top. Moving now to continuation patterns. A continuation pattern is used to predict the resumption of a market trend that was in place prior to the formation of a pattern. Generally, what happens with a continuation pattern is that there is a change in ownership from one group to another. And the thought process here is that the fundamental economics don't change. It is only that the stock demand has moved from one set of investors to another set of investors. And the pattern occurs while this transition is happening. The two major continuation patterns are triangles and rectangles, which we will cover in the subsequent slides. From an exam perspective, you just need to recognize that we also have something called flags and pennants. These are minor continuation patterns because they form over short periods of time. Typically, you will see them on a daily price chart over a 1 week period. A flag is a smaller version of a rectangle, and a pennant is a small version of a triangle. Here are the various triangle patterns. Notice that these are continuation patterns. We have a uptrend, and then with the ascending triangle you have a shape like this horizontal top line and an angled bottom line, which create the triangle. The tops are the same. The trend line connects the bottoms, so notice the uptrend, but essentially you need to recognize that this is a ascending triangle pattern, which tells you that this uptrend will continue. Here we have a descending triangle, and just look carefully at the shape and try to remember it. And then this is a symmetric triangle where we have lower highs and higher lows, but ultimately the uptrend continues. Rectangle patterns are fairly self-evident. What we have here is a bullish rectangle, which tells us that this particular uptrend will continue. Here we have a bearish pattern, which tells us that the downtrend will continue. Moving now to technical indicators. There are four categories of technical indicators that we'll talk about: price-based, momentum oscillators, sentiment indicators, flow of fund indicators. Now, even though we have two separate categories here, price-based and momentum, but both of these kinds of indicators are created based on price. It's only that momentum oscillators are a little more sophisticated than price-based indicators. On the right, we have two indicators which are not based on price. The fundamental point with these indicators is that we will come up with some numbers based on a formula, and these numbers or indicators will give us a sense for whether the stock will move up or down, whether a stock is in an overbought situation or a underbought situation. Let us start with price-based indicators, and the item that we'll cover first is moving average. Price-based indicators incorporate information contained in current and past history of market prices. A moving average is the average of the closing price of a security over a specified number of periods. So let's say that we are taking a 20-day moving average. This means that we look at the last 20 closing prices and come up with the average. The next day, again, we will have a new 20-day moving average, and so on. That is why this is called a moving average, because the average changes as we move forward in time. Let us try and understand how to take advantage of this concept. What you are looking at here is three graphs, and in black I am going to identify the underlying stock movement. In red we have the 20-day moving average, and in blue we will put in the 60-day moving average. So the blue is the 60-day moving average, and the red is the 20-day moving average. Now let's understand the concept of a golden cross and a dead cross. With a golden cross, the short-term moving average crosses from underneath a longer-term moving average. This is a bullish sign. With a dead cross, a short-term moving average crosses from above a longer-term moving average. This is a bearish sign. So if you look at this cross over here, this is a dead cross because the red line, which is the shorter term moving average, is crossing from above and going under the 60-day moving average. This is telling us that the prices, recent prices, are heading downwards. So the momentum is down, and that is why this is a bearish sign. Another situation which you have over here, this is a golden cross because the red line, the short-term average, is crossing the blue line from bottom to top. This means that the recent prices are heading upwards, and it is a buy signal. That's why it's called a golden cross. The second price-based indicator we will talk about is Bollinger Bands. Bollinger Bands consist of a moving average plus a higher line representing a set number of standard deviations and a lower line representing a set number of standard deviations. Let's say that we have this line in blue, which is a graph representing actual stock prices. Then in red we have the moving average. Let's say that this is a 20-day moving average. We then create these bands on each side of the moving average, which is a certain number of standard deviations from the moving average line. So for example, this might be one standard deviation above and this might be one standard deviation below. High stock volatility leads to a wider band. So here you have a lot of stock volatility, so your band is wider. When there is less volatility, then you will have narrower bands. Bollinger Bands can be used to create trading strategies such as a contrarian strategy. A contrarian strategy is where you go counter to the market. Now let us understand what our move will be. With a contrarian strategy, we sell at a upper band and buy at a lower band. So notice when the stock price comes near the lower band, what this is basically saying is that the stock price is relatively low compared to the moving average, and this is a sign that we should buy. When the stock price hits a lower band, that probably means that most people in the market have sold. So what a contrarian will do is start buying, and if he is right, then the stock price will start moving upwards. What is happening here is that we are near the top band. Top band means that the stock price is high compared to the moving average, and this means that most people have bought the stock. So it would make sense according to Bollinger Bands to sell, and in this particular case that would be the right strategy because the stock price then comes down.